Alright guys, so the US economy is in trouble and the dollar's taking down global currencies. And all this stems from the Fed keeping interest rates high. And why is this? Because inflation is still a persistent problem. We are witnessing a snippet of the endgame where the US economy is starting to lose control, where deficit spending doesn't move the needle anymore and stagflation is here to stay. Core inflation in the US has risen once again in March, which is a big problem. Inflation came in red hot, hitting 0.3% in March. Spending is also up, reaching 0.5% as well. Households in the US, they are spending more than the estimates. And to Powell, this looks like the economy is booming. This isn't really good for the Fed. They know the economy is in trouble. The big problem is the high interest rates. The Fed funds staying at 5.5% is starting to smash the global economy into pieces. Now, you compound this with endless government spending from Joe Biden, it's a recipe for disaster. A hard landing could sneak up behind us. If we look at the markets, they're expecting the first cut to only happen in December. That's at least 6 months away, guys, and the total cut might only be 33 basis points. And this means we could be well above 5% by the end of 2024. This opens up a whole can of worms, especially when the US government has to keep borrowing money. Biden has no choice but to keep the gravy train going all the way to November, and that's Bidenomics for you. For the April to June quarter this year, the US Treasury will be borrowing over $200 billion in debt. But let's not forget about the $95 billion for Ukraine, Israel, and Taiwan, and that adds up everything to $300 billion. That money will have to be borrowed into existence as well. Is this endless issuance of debt that's going to trap Janet Yellen? Because rates are staying high, the more she borrows, the bigger the hole she's digging everyone into. She's trying to juggle debt issuance between the longer term bonds and the shorter term T bills, and for a while this was working. Now, the idea is to borrow more short term debt because it matures faster, and the Fed was supposed to cut rates down, right? It's supposed to happen by now. The risk would only be short term, but that's not the case anymore. Powell can't afford to cut anytime soon. Treasury yields across the board are heading up. The 2-year is at 5%, the 30-year is at 4.8%, the 10-year is above 4.7%. No matter which type of bond the Treasury issues, they are screwed. More capital will leave the real economy. They'll just hide in Treasury bonds. And this will make the global currency crisis worse. Now, higher rates put more pressure on US companies. It will also push the US debt crisis to unthinkable levels. Now, you would think that deficit spending is great for the US economy. You borrow more money today to generate GDP growth tomorrow. But as we said many times here, the money borrowed isn't being used productively. The cash is being sent to fund endless wars. It is diverted to the military industrial complex. It's not being used to create real economic growth. Now, if you borrow $1, you cannot expect to get a return of at least $1 or more. But that's not really the case. The Congressional Budget Office projects the US deficit to hit $1.5 trillion this year, and that's $1.5 trillion borrowed from global investors to prop up the US economy. And this deficit is equivalent to 5.3% of GDP. And in 2023, last year, the deficit spending was around 6.3% of GDP. You would expect GDP growth to match the increase in deficit spending, at least to match it. However, the economy is off to a very bad start this year. The US economy slows and inflation jumps, dampening soft landing hopes. GDP for Q1 has grown by only 1.6%, slower than all the estimates. Economists were expecting the US economy to grow by 2.5%, but it's almost a full percentage point away. Now, what's scary is the trajectory of economic growth for the past 3 quarters. Since Q3 last year, GDP has been dropping quarter after quarter, from nearly 5% down to 1.6%. This is a steep drop that is signaling trouble ahead, and this is coming when Biden is borrowing endless amounts of money to prop things up. So, why is this happening? And it's quite simple. Spending isn't being done effectively, productively. The money isn't used to grow the economy where it matters. A ton of money is used for interest payments on the existing debt. The interest on the national debt has now ballooned to $1 trillion in 2023, and this amount will only grow as the Fed refuses to cut rates. And this is the problem with endless deficit spending at higher interest rates. The money borrowed is used to service the existing loan. It eats up capital and prevents growth in the real economy. And this is something many people refuse to talk about. Yes, Biden can keep the borrowing up, but that doesn't mean GDP will grow correspondingly. This stimulus is already starting to lose effect. Higher rates don't just impact the national GDP, it's starting to crush households as well. We can see a big U turn in consumer spending, especially from the poor and the middle class. The net interest income for households have gone down in this hiking cycle, and this confirms our worst fears. The debt costs for people have risen more than their interest income. The interest income from higher bond yields is nothing compared to the interest payments people need to pay. The net interest income for US households have collapsed this hiking cycle. Now, if rates went from 0 to 5.5%, shouldn't people be earning more from their bond holdings? Why has the income fallen from 900 billion to 670? It's because people's liabilities have grown even bigger. Mortgages are up, and credit card debt is flying to the moon. And this is the double whammy of stagflation people are truly facing. Prices are up, households have to spend more, so they just go around swiping the card. And that traps people in an endless debt cycle. And the longer this continues, it threatens to greater consumer spending. And all this is traced back to wasteful spending from Congress. And you would think that economists like Janet Yellen kind of understand this, right? She should be telling the US government to stop deficit spending. But she's still living in fantasy land. She's operating in the twilight zone. According to her, the US can bring inflation down without hurting jobs. And I kind of disagree. Not at the rate Congress is spending. The further this continues, the longer rates will stay high in the US. And this will hurt companies and consumer spending both at the same time. And all that will boomerang back on American jobs sooner or later. And guess what? Even the IMF is scolding Congress on this. The IMF is warning that the US deficit will pose significant risks to the global economy. And to be fair, the IMF also scolded the UK, China, and Italy as well. But the US has an outsized effect on the world. By 2025, the IMF projects the US deficit to hit 7% of GDP. Now, if you look at India and China, they are borrowing more than the US. So what gives? Why is the IMF picking on the US? Now, firstly, China and India's GDP growth rate is much higher than the US. Secondly, most of their debt is domestic while US debt is more globally held. But most importantly, these two countries they don't own the world reserve currency, but the US does. They hold the power of the dollar. They have the one ring. The IMF says spending from Congress has increased core inflation by 0.5%, and that in turn will cause rates to stay higher for longer. This isn't just a problem for the US, it's a big crisis for the world economy, and here's why. The dollar is the reserve currency. Everything is priced in dollars, so when it strengthens, imports for countries outside of the US are more expensive. And when the Fed keeps rates high, it vacuums money away from the world into US bonds. Investors realize that they can get over 5% in US bonds, so they dump their local currencies to buy dollars to invest in treasuries. And that sends the dollar higher and crashes currencies all around the world. It's a chain effect. But it isn't just an inflation problem, it can destroy global growth as well. And it all boils down to higher interest rates back in the US. A 1% spike in US rates leads to a 90 basis points rise in advanced economies. For emerging markets, the rise is 1% as well. So everyone suffers when the US keeps rates higher, and this is exactly the situation happening today. A great example is the Japanese yen, because yields in the US are over 5% while in Japan they are under 1%. This causes money to leave the Japanese yen. The sell-off isn't done yet. The currency has weakened above previous intervention levels. It's now 158 yen to the dollar. Imports to Japan are now more expensive. People have to pay more. Japan is an example of a country that has no choice but to watch their currency collapse. Because of their own debt crisis, they can't raise rates to counter the Fed. The only option left is to watch the yen get devalued. And this is happening globally, not just in Japan. Currencies and economies are getting clobbered. And that's why the IMF is sounding the alarm. America's deficit spending is hurting other countries and the pain isn't over yet. Now, the problem goes beyond just a slump in GDP. It goes beyond high inflation on Main Street and even global currency crisis. Higher rates are starting to collapse US banks once again. We have a new bank failure today. Regulators have taken control of Republic First Bank, and this is the first US bank crash this year in 2024. And it's a story of how higher rates are destroying the balance sheets. And here's how bad the damage was. Their total equity, which is assets minus liabilities, fell to $96 million. But because they had 260 million in mark-to-market losses on their bonds, the bank is broke. They're effectively underwater. The bank was worth negative. Now, this isn't a huge entity like SVB. Their assets in total were only around $6 billion. But it does highlight how higher for longer is destroying the assets of banks, how we can really drive them towards bankruptcy. When yields go up, everything from treasury bonds to real estate loans start to fall in value. And if it falls enough, the bank is finished. Now, what's the good news? Depositors didn't lose a dime, but it doesn't mean the next bank collapse will be that lucky. Depositors could lose money this time. And that's why we keep talking about gold on this channel, right? It's crazy not to have some. And let's understand the scale of the problem. US banks have a ton of unrealized losses on their books. At the end of last year, they were $600 billion in the red, and these are paper losses just waiting to be exposed. It's essentially a ticking time bomb that could explode the longer power refuses to cut. And what's frightening are the paper losses in red. Those are the held to maturity or HTM bonds that are underwater. Now, their banks expect to hold these bonds until they mature, and they could be for the next 5, 10, or even 20 years. But there's a big problem here. If the crisis gets bad enough and the banks need to sell those bonds, a big repricing will happen. For some banks, the losses could eclipse their overall assets, which means bankruptcy. Now, if depositors run away or if other parts of their portfolio implode like commercial real estate, then we are in big trouble. The bank could be forced to sell and realize the losses. Their books could literally explode. And this is the risk of higher rates. It makes the entire economy built on leverage extremely shaky. So until the Fed starts cutting, there's systemic risk in the system. This is the black swan risk from the US banking sector. Let's put things in perspective. The banking collapse last year totaled over $500 billion. That's 200 billion more than the failures in the '08 crisis. That's how severe things were. And because of inflation, the Fed can't cut rates for quite a while. A lot of nasty things could happen from now until the first cut. It might only happen in December, and by then, even cutting rates might be too late to save the system. So we are in a very serious situation. US deficit spending is not efficient anymore. Inflation is still high, but to prevent a collapse, borrowing simply can't stop. We are moving closer and closer towards stagflation. Now, economists ran a million simulations on the US government debt, and guess what they found? 88% of the tests showed the debt to GDP is on an unsustainable path. Eventually, we will reach a point of default. Either the US government can't physically pay the debt, or they will just print money and devalue the dollar. And as Biden continues to borrow tons of money at higher rates, he's pushing us dangerously closer towards the end game. And by 2050, the interest cost on the debt alone might hit 6% of GDP, 6% of the entire US economy. The value created there will be used to pay just the interest payments on the debt alone, and that is by definition unsustainable. Oh, Sean is fear mongering again. Guys, this isn't fear mongering, it's pure mathematics. If we want to save the US economy and by extension the world, we need to stop spending. And the first step is to stop the two wars happening today. The financial black hole and the endless borrowing has to stop. But let me know what you think. Is the IMF right about the US deficit crisis? And are more banks on the verge of collapse? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these insane times.